Today we're going to talk about tokenized assets. We're going to focus mostly on real estate, a little bit into healthcare, and really what I see is just kind of a modern way to finance traditional assets. And I figured we'd all start out, everyone take a few minutes to introduce ourselves, and then we'll start at that end and come around, and then we'll get to questions. So,
first of all, congratulations for making it this far today. If you're here, you're one of the warriors. So my name is Leeor Shimron. I'm the CEO of Nova Block Capital. We are building the next generation of capital markets.
Hi, everyone. My name is Joshua Rivera. I'm the general counsel at Blockchain Capital. We are one of the original investors in the blockchain and crypto space. We also had the privilege and then later the brain damage of pioneering the first security token and tokenized fund. That's the BCAP. So after having done all that, we're very invested in the digital asset space. We invest in all verticals in the industry, and we're continuing to look for innovations both in kind of traditional crypto assets and security tokens.
And I'm Doney, the CEO of Securrency, and we make blockchain-based financial services infrastructure for banks and investment banks. In general, we make it easy for issuers to bring their offerings to market so that folks don't have to be the expert that Joshua is. The rule sets are baked in a very easy workflow that is similar to using TurboTax. It sort of walks you through what you need to know from a securities perspective to bring your offering to market. And then the key thing that follows is your tokens know what they're allowed to do. So they can only participate in transactions between known and qualified parties. And that's the key to opening up the next generation of liquidity that we're after.
Great. And my name is Dara Albright. I'm a fintech advisor. My passion is really creating content into the space, content in the space, as well as kind of utilizing the emerging technologies, as well as the navigating the regulatory changes to create new ways of financing various asset classes. I recently started consulting for Eisner Amper, a global financial advisory and accountancy firm, and together we're creating some really innovative content, bleeding edge content in the space and educational platforms. So, okay, let's jump right in. I think the first thing that we wanted to get this off the ground is, and I don't think what people realize, but there is a big difference, I think, between security tokens and tokenized assets. So, maybe, Leeor, you want to start off and just kind of give us, what are those differences?
Sure. So I think digital securities, that's what I like to call them, same as security tokens, smart securities. They're essentially a way to embed certain financial rights, ownership rights, utilization rights into the token. So they're very, very different from crypto assets, where something like Bitcoin or Ether essentially is a payment token that allows you to transmit value over a network. Security tokens kind of bridge the gap between the digital world and the real world. So a lot of it is about trying to tokenize or fractionalize traditional assets, and allowing people to actually gain access to those assets in ways that they couldn't before.
And do you see it also as using tokenization as a way of, as a mechanism for compliance? And how is that working? How are you actually embedding the compliance into the asset itself?
Sure, yeah. I mean, compliance is paramount. It really is probably the biggest feature. Compliance essentially allows you to make sure that you're eligible to trade the assets. So, you'll have whitelisted lists of folks that can actually access the assets. And what's interesting to note is that with security tokens, they're compliant from day one. They're not like crypto assets where, are they securities? Are they not? We know from the start that they are securities.
Yeah, I just add to that what this technology allows is really a boon for regulation and regulators. So you see this tension in the crypto space between the assets and the people that are trading in the assets, and the regulators who are still trying to wrap their minds around what the space is and how they kind of bring it under current regulation. What digital assets or security tokens allows what the concept allows is for regulators to have transparency and auditability of securities in a way that they've never had before. So that's actually really exciting, and I think it's like the one area where our firm speaks to regulators. We try to advocate for the industry, and whenever we sit with them, we go down a long list of here are all our grievances, and here's what you're not doing right, and please give us a no action letter, which the SEC did. We shouldn't talk about it because it's not exciting, but the one the one place where they kind of really lean forward is when we talk about security tokens, because they realize that this provides an opportunity for them to revolutionize the way they do their job and regulation, which we think is a really good thing, for the advancement of regulation, but also building kind of rapport with the regulators that we're trying to get to allow us to do the things that we want to do.
So that we were debating securities law backstage, and what you see is there's so much complexity associated with securities law, here in the United States as well as overseas, that it takes issuers, someone who's bringing a new offering to market. You have to hire counsel. What you find is if you talk to 3 different law firms, they'll have 3 different opinions on what thing is legal. What's cool about the new security token framework is you can codify those practices. We call them recipes, and you can attach them to the token so that when there's precedent, when you've seen 10 people successfully do offerings before you, you can use those same policies and apply them to the tokens. But as Joshua said, it's very easy then for regulators to look in and see that you are in fact following securities regulations associated with these transactions. So they have a kind of verifiability and repeatability that they haven't had previously in this market. But here's the key. If mom and pop are transacting in a securities token, so if they're engaging in a transfer of this token, because you can, these are on distributed ledgers, it's easy to actually move those shares. If they have to be familiar with securities law in order to decide whether or not they're able to send this token here or place this order into a market, you'll have no liquidity. It's hard enough for investment banks to make those kinds of decisions with floors of compliance officers. But this is what's great about smart securities. The securities themselves actually know what they're allowed to do. It radically changes the way that securities transactions are done. And it creates new opportunities where securities aren't just pieces of paper that sit in a desk somewhere as a certificate or on a spreadsheet in a law firm that have to be verified. They can now actually engage in transactions that weren't previously possible. That provides a whole new series of applications that we'll talk about here in a minute.
Yeah, and let's talk about the law a little bit, but from a non-lawyer perspective, because all of us we see it. We're utilizing and doing it in a legal way, but we're not lawyers. So just from right. Oh, you. Oh, okay. I'm sorry.
But I'll try to take that hat off. Yeah.
Okay. But you're out there and you're doing this and you're applying this, and so there are certain ways that you could do. There's Reg A+, there's Reg D, and I'm just talking just in the U.S. There's Reg CF. So just from a use case, how are you recommending companies that are going out there and trying to kind of navigate the regulatory landscape? How are you guys now telling companies which do you think is the best exemption they should use, or should they be registering? How are you navigating that for your clients?
So the overall majority of offerings to date are Regulation D, and that really limits the investor base that these issuers can reach out to, because you have to be accredited.
Right.
We, at the end of the day, if we only limit ourselves to accredited investors, we're kind of missing out on the full potential of this technology. At the end of the day, we want to tap into a global investor base of retail investors and give them access to the best opportunities that they wouldn't have otherwise. And I think regulation really needs to catch up in order to reflect that.
The whole, genesis of this whole industry is really, it's all about liquidity, and it's all about democratizing access to these investment products. And if we're just focusing on Reg D, that's a problem. Where do you guys see the SEC? I mean, do you foresee a Reg A plus qualification coming down soon in this space?
Well, so Chairman Clayton's been very clear about the fact that this is a problem. That, in fact, so many great investment opportunities are not available to the broader populace, and this is the thing that the SEC does want to address. Now, they don't pass laws in this case. What's becoming very interesting in this space, Reg CF is a great model because it allows retail investors to come into the offerings. The problem historically has been it's so difficult to do the offerings from an investor onboarding perspective, from the legal costs associated with doing the offerings, that the $1 million limit associated with Reg CF offerings, you are cutting into those costs significantly. But when you automate the workflows, there's a number of platform providers in the space who can automate the actual token issuance workflows, including the investor onboarding components, you drive the cost down to the point where it's actually practical to do these offerings with the click of a button. And so in that context, Reg CF suddenly becomes a viable option for folks in their early stages. As we see Reg A+, now again, I know Leeor and Joshua have a lot more opinions on this, they're better informed in this. The SEC has yet to put forward a Reg A+, as many of you know. It's the difference between affirming, so for the SEC to affirm a particular approach is different than them objecting to a wrong approach. There's a lot more latitude in Reg D than there is in Reg A+, but once that door is opened, you'll see a repeatable process that allows folks to get to a much broader audience.
Yeah, I think we're waiting for the SEC to approve a Reg A+. They've got a long kind of list of applicants, and unfortunately, it's just taken them a long time to get through it. I think they can help themselves significantly by providing us a model that then we can all follow, because there's a significant portion of the crypto industry that really wants to, these are people who are saying, I don't even want to try to make my token not a security. I want to make it a security. I want it to behave like a security, and I want to give it the type of broad dispersion that public equities have or public securities have. And so there's a significant portion of the population that really wants to engage, and we just haven't been given the roadmap yet. There are some technical kind of incongruencies that the SEC works on forms. So when you apply for Reg A+, you have to fill out a form that requires all of this disclosure. That disclosure is what ends up getting into the hands of the purchaser of your security. And that disclosure was created at a time where digital tokens were not contemplated. So there are incongruencies, and that's part of why the process has taken a long time. But it's we're hopeful that the pressure from the industry really causes the SEC to modify those forms.
Yeah, I think if I had a magic wand, there are two things I would change in terms of the regulation. Number one, I would expand the definition of accredited investors. Mm-hmm. It makes absolutely no sense for, let's say there's a teacher who has a degree or is teaching computer science. They're way more informed and eligible to make an investment decision than someone who's just sitting on a pile of wealth. So expand that definition, allow it to be more inclusive with more people. And the second thing is for Reg CF was a great step in the right direction. It allowed companies to raise $1 million very easily, being exempt from registering with the SEC. But how much can you really do with $1 million? We should expand that, increase that limitation to maybe $10 million. Now you're talking. Now you're giving early stage companies more breathing room and the ability to actually play.
Yeah, I think just to respond to that, I agree with you. I think what kind of haunts the SEC's nightmares is people losing a significant amount of money. So while it's a completely legitimate kind of criticism to say, hey, like you can have lots of expertise, but lots of expertise doesn't equal affluence or wealth or spendability, and you should still be qualified to invest in things. What what scares the SEC is that, well, I don't want somebody who, only makes, $70,000 a year to invest in something that they could lose significantly.
UK law actually handles this pretty well, and it's something that if you were to change the law would be handy. The question is not whether or not, well, they do have a definition of sophisticated investor, but importantly, folks are allowed to invest a certain amount in any offering. It's really, if you don't invest more than, say, $5,000, does it matter whether or not you have $1 million worth of assets, et cetera? So those are some simple changes that would be cool to see.
Yeah, that's a great thought.
Yeah, and there is a bill that actually passed the House a while back to broaden the definition of an accredited investor to make it more knowledge-based as opposed to, financially based. And it passed the House by overwhelming majority. It's sitting on the Senate floor. So, I mean, there's hope, but...
Yeah, I think, being optimistic, Hester Pierce, the SEC commissioner, was in New York a couple of weeks ago, and she outright said that accredited investor laws should be abolished.
Yeah.
So I think sentiment is slowly changing, and they understand that it's a problem, and they want to be more inclusive. But I'm not gonna hold my breath.
Hester Pierce is she's kind of the
Crypto
maverick.
mom.
Kind of super small government. But yeah, I agree with her and with you. So
I actually sent her a paper that I wrote basically calling the accredited investor definition completely undemocratic. So I would love to see that happen. So let's just talk a little bit specifically about the real estate space and how utilizing even some of these exemptions, qualified exemptions, are really specifically going to enhance or change real estate investing. And let's talk about it even from the issuer perspective, from an institutional investor perspective, as well as a retail investor perspective. And I'd love to hear your thoughts on that.
Well, look, so the 2008 crisis was largely a real estate problem as mortgage-backed securities. And the central problem in 2008, of course, was lack of transparency in these multi-billion-dollar mortgage-backed securities portfolio. Lack of transparency is exactly the problem that blockchain solves. So in terms of those fundamental problems in real estate, there's clear solutions. Now, you see a lot of folks doing tokenization of individual real estate assets, that is fractionalization of those assets. We actually think this is a bad idea. There's certain times when that's a reasonable thing to do, but it doesn't scale. Here's why. If you have an asset and you fractionalize it, and now you have 200 owners of that individual asset, and now you want to actually sell off that asset, or someone wants to buy it, now you have to deal with a huge number of folks who have to actually participate in that specific transaction. There's better ways. So actually taking a fund, a real estate investment trust, and issuing shares against that fund and allowing the assets to roll in and out of the fund are better ways to address these problems. But clearly, the real estate industry is one that benefits from increased liquidity. It has the deepest business cycles precisely because of liquidity problems. And so we expect security tokens to make the biggest difference in the real estate space.
Yeah, I think real estate investing has really great meme value. And I lead with that not to say that there isn't actual value in real estate, tokenizing real estate, but I think it's a very tangible use case for kind of the general population. So you can understand kind of owning real estate and not being able to exit that position easily, right? Not having liquidity in your real estate holdings. And so it provides a very good example of how tokenization helps with the kind of the clearing and settlement parts of transacting securities. That being said, I think real estate is, it being kind of patient zero, or well, I guess funds are patient zero, but and maybe the next candidate. I think tokenized securities are going to outpace things like tokenizing real estate, tokenizing funds. I think they're going to be much more exciting applications for security tokens than just that. So I think kind of hopefully 10 years down the line, we'll look at tokenized real estate just as real estate, right? And it's just like the way you invest in real estate and anything else is through this digital process that's superior because it facilitates all of these back-end processes that make these transactions so costly and so involved.
Yeah, I want to echo a lot of the points that Josh and Dan made, but I completely agree. I feel like tokenized REITs are definitely a strong use case. That is a big market as it stands. Especially in the non-traded REIT market. We see $5 billion of new issuances every year, and there's also an existing inventory of $100 billion. And these are traditionally very illiquid markets that if you try to exit a position, you often have to take a 40 to 50% haircut. And I think that's a function of just, there not being a robust market in place and, being able to, through tokenization, automate a lot of these back-end processes can really resolve that and really reduce the cost of capital.
Well, would Reg A Plus be a solution? Because then we're also talking about, caps at the amount that they could raise. So is that, are we even to 50 million? Is that...
Right, so for Reg A Plus, there is a 50 million cap. For some of the existing crowdfunding real estate platforms like Fundrise, Realty Mogul, what they'll do is they'll actually register like 8 or 9 different Reg A Plus offerings and kind of bundle them together. And that allows them to really hit a much higher target amount. So you can really apply this, that methodology into this industry as well.
I think you made a really great point too, and you said before you talked about, we're not even going to be talking about this at some point in the future as a tokenized, real estate transaction. It's just going to be real estate transaction, real estate investment. Let's talk a little bit about just some of the structures that are being used in the types of capital that's being raised and from like debt, equity, rev share, and how that's working, how that could benefit the investing landscape as well.
I'll go first, I guess.
Okay.
I know Leeor, I suspect, has the same opinion as me on this. We came into this space, income-bearing securities are the most interesting from our perspective because they can be the most liquid. So when you have an asset that produces a dividend, its pricing can be much more efficient than if you have an asset that's much more speculative, like a startup. The reason is you can look at the track record. What kind of income, what kind of dividends was it producing? And so therefore it makes it much easier to trade those individual assets. So we see all kinds of solutions in the space. Man, we're approached all the time on our platform for things like commercial real estate leases. So securitization of commercial real estate leases has been a massive problem. It's $1 trillion problem for the real estate industry. Without securitization of these leases, tokenization and securitization, it means that the developers, who are good at producing value, are locked in for the long haul while they are accruing the income from the assets. If you can sell the assets, they can do what they do best and move on. You see the same thing with structured settlements, factoring in general, trade finance, et cetera, where when you have, and even healthcare. So healthcare finance is a real problem. Slow moving and accounts receivable are a big problem there, which can easily be securitized. So we think the next big move in the space is going to be into income producing assets because they're much easier to trade. That's where you get real liquidity.
Yeah, I think you're spot on. What makes real estate so attractive is that you can map out the cash flow payments for several years out into the future. And you kind of just do that discounted cash flow analysis and you get the present value. That's how much you should pay. So that really pegs the valuation to a very reasonable amount, obviously very similar to crypto assets, which are all over the place. So I think that's also kind of going to enable more institutional investment to come into the space because they know what they're getting.
Yeah, I would just add, I mean, I think that's all right. That's all correct. And, I think for us, even though we pioneered the tokenized fund, it was more, for us, from our perspective, it was more like, let's try to practice what we preach and actually utilize the blockchain in a way that's interesting. And I think, again, kind of into the future, funds will just be tokenized because having things digital rather than having things paper will be more efficient and make more sense to us. But I think, where we think the real excitement comes in is in things like revenue shares, where you can tokenize those, you can tokenize dividend payments. You can tokenize arms of your business rather than, just tokenizing your cap table as a company. So maybe I don't, want to own Apple, but I want to own the MacBook Pro, or I want to own, the iPod. Do they still do iPods, like the minis, the nanos? No. So I think that those are kind of and I don't think Apple would do that in that way in particular, but this is kind of like a thought experiment to imagine what it might look like. And I think the other thing that's really interesting about security tokens is it will allow us to interact in the decentralized finance space in a way that is really difficult to kind of grasp right now. So when you talk about a platform like MakerDAO or other platforms where you can essentially create a lending facility by yourself, and so MakerDAO allows you to take an asset, Ethereum or ETH rather, and use that asset as collateral to then pull out a stable coin, and then you can then use that stable coin to buy a house, and then your house is leveraged. It's not a traditional mortgage, but you have an asset you have an asset that is providing collateral for that. You can switch that asset out with a security token. So instead of using ETH, you can use a token that represents some other asset. And so you can see the opportunity for decentralized finance to work in really interesting ways that I think we won't kind of fully realize right now, but we'll just have kind of these really interesting opportunities down the road. And that's really kind of what is exciting. Those are kind of the opportunities that allow for that kind of parabolic growth when you can just create structures that are different from how we do finance today.
Yeah, look at it. An example of this would be, imagine a portfolio of property usage rights, or in other words, rental income streams. So the owner of those rental income streams holds a token that pays a dividend proportional to the rental income streams. But where that token can actually be traded in for the usage rights of the actual properties that are in that portfolio. So suddenly you have a security interest, just as you always have had before. That's nice, you invest in it, you receive a dividend, but suddenly you can use that share for access to properties. So it's a hybrid between WeWorks and a real estate investment trust kind of model. So those kinds of instruments, it was never possible to use your share of an investment instrument before like this. What that changes is the real estate industry generally, because suddenly, in the old model, the tenant and the landlord were opposed to each other. The tenant had no interest in improving the property. The landlord, of course, just wanted to maximize the value associated with the property. But if you're a user-owner, sort of usership, in between where you benefit from the upside of the property, you can improve it while you're there, even if you're there just for a few months, because it's helping you. It's a different model for the way that we use, for example, real estate. And we expect this to open up in all sorts of different models, as Joshua was leading to.
Yeah, and I think it also allows you to really invest or express more targeted investment theses. Mm-hmm. When you unbundle different ownership interests and you can fractionalize ownership, you can create new investment products that you never had before. And then you can take leverage long and leverage short positions. Let's say, you're bullish on Midtown Manhattan and you want to invest in a pool of properties, of commercial properties. So you want to go leverage long on that position, but you're less sanguine on San Francisco and you want to take a leverage short position on San Francisco so you can hedge your position through that. I think that this technology really enables that type of mechanism and really opens up a whole new pool of opportunities.
And it's interesting because it fosters all of this ingenuity and creativity, which also then leads to greater diversification, and in a sense, you're really getting to that point where you are mitigating risk for the retail investor, which is really the main concern of the regulators. So I think we're all, and I would say even a lot of people here are in agreement on really real estate, tokenized real estate being the next frontier. But we had an interesting conversation the other day talking about some of the trends, the global trends that's really going to impact, and really, really see this industry, this sector really start to scale. And want to talk a little bit about that?
Sure. So it isn't any secret that there's a ton of foreign capital pouring into the U.S. real estate market, specifically from Asia. Actually, from China itself, you have $20 billion poured every year to buy U.S. Real estate assets. This is just another mechanism for foreign investors to get access or get exposure to U.S. Real estate. And I think they're going to view this really as kind of a more beneficial way of doing so.
Yeah, we're doing the first ever cross-border trading of restricted securities. So we're working with a familiar regulator and the regulator from another country to show that we're able to do these transactions where the tokens themselves actually know what they're allowed to do. On executing that particular transaction, we simplify the access to, for example, Chinese investors here in the U.S. The number of high net worth individuals in China is growing at twice the rate here in the United States. And the rates are much, much faster when you go to emerging markets, as you see new wealth growing up in many other settings as well. And those folks don't have easy access to U.S. markets and vice versa. When you're able to enforce, through this new framework, global securities regulations inside of the token, you can get access to that new capital, and it's growing so fast.
So you're basically programming the rules from each individual country that
into the tokens.
That's
so you can add
fascinating.
various jurisdictions. The recipes can all be combined together, and again, the tokens then know what they're allowed to do across each of those jurisdictions.
That's fascinating.
Yeah, I think what we're just trying to do here is really create a global pool of liquidity.
Yeah.
Just allow for a more seamless trade between international investors. And we all know this is not a zero-sum game. Anyone that studied Economics 101, when you open up trade and liberalize economics, you really expand the pie for everyone.
And we started talking about that a little bit backstage too. We were talking about some of the tax implications from the international tax implications. So we want to talk a little bit about that as well, especially when it comes to real estate investing.
So I'm no tax expert, but I stayed at a Holiday Inn Express here. I do not take anything I say as guidance. My lawyer will come from D.C. to tackle me. So there's implications associated with transactions from U.S. to non-U.S. users of U.S. real estate. So you can accidentally trip across significant tax implications associated with those transactions. If you build that logic into the tokens themselves, it can prevent you from executing that transaction inadvertently, or at least alert you to what the consequences are associated with the transactions. So if you add up tax law, Bank Secrecy Act regulations, securities regulations, just for the United States, and then you add on to that rule sets associated with Singapore and the UK and the UAE and Japan and China, you'd have to be, and this is the case, there's very few institutions currently who can engage in these transactions, and they dominate the market at massive fees. When you can teach the tokens what to do on their own, suddenly it obliterates the lock of the major investment banks on these kinds of transactions. And suddenly they're going to become easy. And again, these transactions will become global. Where thank goodness you don't have to be a tax lawyer. We love our lawyers, but we're not all in that game.
Sometimes. I think that brings up a really interesting question of, we talk a lot about the secondary transactions and the ability for these tokens to trade after, whether they're restricted or unrestricted. And that opening up kind of global liquidity. I think these are things that are going to cause regulators to look up, because then the question is, well, do we want to encourage the $20 billion of inflow from China into U.S. real estate markets? Some people may
coming
think
whether you want it or not.
Yeah, we hear that. But it, we may be opening up the faucet there. And I don't have a position on that. I think that people will feel strongly about that one way or another. And so some of these things will create kind of spaces for debate as to how we ought to actually allow the flow of transactions. And that's kind of the downside to security tokens, is because they are going to be subjected to regulation, and so that tempers the kind of the freedom of the space in a way that utility tokens doesn't. And so just a curiosity on my mind. I would be curious to see how, regulators and lawmakers and society kind of react to some of these freedoms that security tokens allows.
Yeah, I'm not a lawyer, so I don't want to speak specifically to any laws, but there's kind of this general sense that I guess smart contract technology will replace lawyers or the need for lawyers. I think that's completely misguided. If anything, it's going to make them more productive and can automate a lot of the processes that they have to do anyway. So obviously, it's just a new tool for lawyers to engage with to make their lives easier.
Thank you for saying that. Thank you.
So we were also talked a little bit about this. We talk about retail investors at least having access to some of these products. One way is obviously through retirement plans, and we saw the first pension fund enter into the space recently. Do you guys see that? When do you see the pensions, the big institutions, really penetrating the space? A lot more than dipping their big toe in. But when are they really coming in full force? And do you see that as really where this is headed?
Yeah, I'll take this one. So, as investors in the space, and the way venture capital works is, we're not really investing our own money; we're investing other people's money. So it's important to us to see where pensions and other endowments and things like that are putting their money. What we have seen so far, or kind of what is the general truth in the space, is that big pensions, endowments, they tend to be very conservative, and they tend to change very slowly. Up until mid to late last year, there were still some really significant difficulties with tokens in general and security tokens in particular. For example, regarding custody. So there just weren't great custody solutions for where you could hold your token. So if you wanted to sell a token of any kind to a pension, they would ask you, well, what do I do with the token? How do I hold it? And then you would take them on this long, rabbit hole of what, a wallet is, and the difference between like hot storage and cold storage and private keys, and having kind of multiple authentication factors for the people who can access them. And they just would have asked you to leave politely. So there are things that are, now we have coin-based custody, we have BitGo, Fidelity, IBM apparently is quietly working on a custody solution. There are other major institutions that are coming into the space to provide solutions for those issues. So I think that's evolving, but I think where pensions are still, they still want other people to kind of drive the bus for them. They want to go on the ride, but they really prefer to kind of give their money to someone who's going to invest and kind of not only just manage the custody and the technical issues that come with digital securities, but also just kind of managing the investments themselves. I'm sure again that will evolve, but I think it will take time.
So you're telling me that pension funds do not want to hold on to their own treasures?
They don't.
Yeah, I think you're right. Obviously, pension funds are notoriously slow-moving. What's been leading the space has been, the angel investors, high net worth individuals, family offices. They just naturally, they have much faster-moving processes internally, and they don't have to go through these bureaucratic rungs to get approval to make any particular investment. I think a lot of it's also going to be issuance-led. At the end of the day, a good deal is a good deal. If they see a good real estate investment that's going to be returning them 20% plus annually, that is what's going to get them over the line. So really the investment has to go on the merits of the deal itself.
And I think you make a good point too, where you're talking about a lot of these companies are actually coming out with custody solutions, because when they're big names that we know, people that would feel comfortable. And I think that's the big thing too. It's not only introducing the technology, but it's enabling the ecosystem, and especially the conventional players with this. You're introducing them to a whole new world, really helping them not only show them that there's technology available, but making them understand and feel safe and comfortable where those assets are actually being held. So I think there's also an educational gap that needs to be filled too.
I think Leeor's point was particularly important there. There hadn't been good institutional grade offerings in the space. So if you could if you had a great offering and you could easily raise $200 million worth of capital with that great offering, you weren't going to take the technology risk to bring it into this space. So what you saw coming into the space were really the kinds of things that couldn't easily raise capital elsewhere. Well, that's not ever good for any investor, let alone institutional investors. But that's starting to change as you're starting to see A-grade kinds of offerings come into the space, and that's going to change things. And institutional investors seeing that are becoming more educated about what it means, how you can custody these solutions, what the counterparty risks are. And so it's slowly but surely opening up, but there will be a hockey stick moment. Yep. Because you get access to so much more that you couldn't previously access, that you're going to see an uptick in a year or so.
That's a prediction then. All right.
Don't take my advice.
All right, let's get into predictions. Okay, where does this go? Yeah. You have to end every panel with predictions. So
let's see. So I'm extremely bullish on the space, and I think it's an extremely exciting time to be involved. Couple predictions from my end. I think we're going to see over $1 trillion worth of assets being tokenized in the next 5 years. I think we're going to see a unicorn company doing an STO instead of an IPO. I think those are two pretty bold.
Great predictions.
Those are very bold predictions. Use the T word. That's impressive. I'm super bullish. My timeline is a little bit longer. I look at kind of the 10-year horizon. I mean, venture capital, we tend to take longer views. I think there will be a hockey stick moment. I think we're still like 3 or 4 years out from that, because I think that there are still significant infrastructure issues that we have to figure out just in the blockchain capital space, the blockchain space alone and the cryptocurrency space alone. So those processes are being worked out. I think what we've seen is that there are still lots of things that don't work the way they're supposed to, or the way that we fantasize that they would. But I think once they do, when they've been given the time to develop that they need to, then it will explode, and it will really revolutionize how we do things. But it took even the internet. It took some time. Banks weren't using email as soon as it was available, or even a couple years after. Now, of course, we can imagine life without it.
So my big bet going forward is on CDOs as the near-term big use of blockchain in the securities space. And here's why. Banks are, non-bank lending is going up significantly because banks have been very restricted in their ability to lend post-2008 crisis. So that's given rise to companies like Prosper, et cetera. But they're running out of funds because they don't have efficient models for securitization, among other things. There's a great solution out there, again, that fixes the problems of 2008 and gives new access to capital. Well, here's why that's so appealing at the institutional level. There's great yield in those portfolios, 6, 7, 8%, and it can be diversified across a large size lending pool with full transparency using blockchain. So we see that being a big offering. Similarly, treasury repurchase agreements. So if you're into finance, you see that money market accounts can actually be done better on the blockchain. What that means is you can get, instead of 0.25% interest on your savings account, you can have treasury-backed instruments that get you 1 to 1.25% that you can monetize into dollars on demand. So that's sort of a category killer for bank savings accounts. So we see those two as being big applications that we're right on the cusp of being able to issue.
Great. I think we're ending here, but I will just say that I think all paper money, coins, disappears. I think that's just like, no, people aren't writing things on stone anymore. I mean, I think that just goes away. And I think ultimately crypto displaces equities. I think we're going to see that at some point in the future too. But this was great. Now everyone could race to the bar. How about that? Thank you.